What happens when the world's ultimate safe haven suddenly behaves like a high-risk tech stock, wiping out trillions of dollars in value in a matter of hours? On Thursday, gold fell nearly $500 per ounce from its record peak, erasing an estimated $3.4 trillion in global value, while silver suffered its sharpest single-day plunge in years. The shock did not originate in mines or vaults, but on trading floors watching America's technology giants unravel, raising a deeper question about how safety, liquidity, and power now interact in global markets. If this breakdown deepens, the consequences extend far beyond precious metals charts. Gold and silver are not only stores of value but collateral, liquidity backstops, and psychological anchors during stress. If they fail to stabilize portfolios when equity markets fracture, investors are forced to reassess what safety actually means. A successful stabilization would reaffirm bullion's role as a systemic shock absorber. Failure could amplify volatility across currencies, sovereign debt, and emerging markets already strained by high interest rates and political risk. To understand how this moment formed, it helps to trace the forces that drove gold above $5,000 per ounce in the first place. Over the past year, bullion nearly doubled in price as global investors reacted to elevated US government debt, geopolitical tensions involving Iran and major trade routes, and persistent uncertainty around inflation and growth. Central banks added gold at a record pace, while retail demand surged amid concerns that traditional portfolios were increasingly correlated. Silver followed with even greater momentum, driven not only by monetary hedging, but by industrial demand tied to artificial intelligence infrastructure and green energy expansion. By late January, gold peaked just below $5,600 per ounce, while silver surged above $121, marking its strongest monthly gain outside the late 1970s. These moves coincided with aggressive positioning in futures, exchange-traded funds, and derivatives, creating a market structure vulnerable to sudden reversals. When prices rise this quickly, stability depends less on fundamentals and more on the availability of liquidity and the willingness of institutions to intermediate risk. The trigger arrived from an unexpected direction. US technology stocks, long seen as engines of growth and stability, began to crack. Microsoft lost nearly 12% in a single session after earnings revealed slower expansion in its cloud and artificial intelligence segments, erasing roughly $250 billion in market capitalization at the opening bell. Oracle fell more than 5%, Nvidia declined, and broader fears spread that the AI investment cycle may have peaked faster than expected. As equities dropped, leveraged investors faced margin calls, forcing them to sell what they could, not what they wanted. Gold became a source of immediate liquidity rather than protection. As funds liquidated bullion holdings to cover losses elsewhere, volatility intensified. Market makers reduced exposure, trading volumes shifted abruptly, and price discovery deteriorated. In a single day, gold plunged more than 8%, while silver fell sharply from its highs. Bitcoin, another perceived alternative asset, dropped over 5%, reinforcing the pattern of synchronized liquidation. This was not a rejection of gold's long-term value, but a short-term scramble for cash in a stressed system. The mechanics of this sell-off matter. Exchange-traded funds tied to gold saw their heaviest trading volume since late October, signaling institutional repositioning rather than retail panic. Futures markets showed rising activity in gold even as silver volumes declined, indicating divergent hedging strategies. At the same time, the US dollar edged higher after falling to four-year lows earlier in the week, tightening financial conditions just as liquidity was evaporating. These cross-currents created a feedback loop where price swings fed further selling. Two future paths now come into view. In one scenario, volatility subsides as equity markets stabilize and forced selling ends. Gold and silver could reassert their roles as portfolio hedges, supported by central bank demand, industrial usage, and geopolitical uncertainty. Prices might consolidate below recent highs, restoring confidence without repeating the excesses that made the crash possible. This outcome would reinforce the idea that bullion remains a strategic asset, even if it occasionally fails under acute stress. In the alternative scenario, instability persists. If technology stocks continue to slide and liquidity remains constrained, precious metals could face further drawdowns as investors prioritize cash and short-term instruments. That outcome would challenge assumptions held by sovereign funds, pension managers, and central banks, potentially accelerating shifts toward alternative reserves or currency diversification. It would also expose how deeply interconnected modern safe havens have become with the very financial systems they are meant to hedge against. The geopolitical implications extend beyond markets. Gold's surge earlier this year reflected rising global fragmentation, from strained US-Iran relations to trade disputes and security realignments. A sustained breakdown in bullion stability could complicate policy decisions for countries relying on gold to buffer sanctions risk or currency volatility. For emerging economies, sudden swings in gold prices affect balance sheets, exchange rates, and borrowing costs. For advanced economies, they influence inflation expectations and financial confidence. As of now, prices have partially rebounded, with gold and silver recovering from their intraday lows but remaining well below record peaks. This rebound suggests that underlying demand has not vanished, but the episode has recalibrated risk perceptions. Investors are being reminded that in moments of systemic stress, the hierarchy of assets can shift rapidly, and even long-established refugees are subject to the mechanics of leverage and liquidity. The deeper lesson is not about whether gold is safe or dangerous, but about how modern markets transmit shocks. When capital flows are global, balance sheets are finite, and narratives move faster than fundamentals, stability becomes conditional rather than absolute. The coming weeks will test whether confidence returns to precious metals or whether this episode marks a turning point in how safety is priced. What to watch next is not just the direction of gold or silver, but the signals around liquidity, equity volatility, and policy responses. These forces will determine whether this crash is remembered as a violent pause in a longer trend or as a warning that the concept of a universal safe haven is being quietly rewritten in real time.